Good morning, good afternoon, good evening, everybody. Welcome back to the King's Table podcast. We are back with episode number 15. I am here joined with my friends, Maddie Atchison and Aaron Amuchastegui. Good morning. I think we are missing Mike today, but we're going to have a really great conversation. We're committed to continuing to have this conversation regardless if one of us is missing. So lots of different topics today, guys. Maybe we start out with sort of general market. CPI numbers came out last week showing that inflation is actually cooling a little bit. We're seeing the stock market just thrive in the last week. It's just been hitting records. I think like the market has been adjusting by like 5 or 10% in the last week in the positive direction. Just today, Bitcoin is up 5%, right? What's the price of Bitcoin today? Around 37,000 for Bitcoin. Even Ethereum is up about 4%. So things are moving. Jerome Powell announced yesterday that actually what's interesting is he thinks that maybe we haven't done enough and that inflation should still be controlled and we may even have to increase rates again. So that could also affect real estate prices, the markets in real estate. So get some of that perspective. But I think generally, what are you guys seeing out there? What are you working on? How is this affecting your day-to-day business decisions? Let's kind of start with that. Besides the fact that your stock portfolios and 401ks have had a nice week or two.
Yeah, they have.
Maddie, you go first.
Yeah, I mean, just talking about having a nice week. If you're invested in the market, this is why I always am a believer you got to just stay invested through the good, the bad, the ugly. Stay invested. Even if anything, now is a good time, I think, I'm throwing a little bit more money into the market because I think when they do cut rates, that's going to bode really well for the market and everybody that kind of stayed in and dollar cost averaged their way through what felt like a challenging market to lean into. But as of yesterday, we covered this on another show, $740 billion in wealth pumped into the market in one 24-hour span. So it just shows you how quick things can turn a little bit. But obviously bad news is good news sometimes for the market, and good news is bad news. But in this case, good news on the CPI print. And I think PPI came in as well today, which the markets are responding good to. I know, Aaron, you had mentioned maybe not thinking that the Fed was, done raising rates. I'm kind of trying to read between the lines there of, I think Powell is kind of trying to keep things a little bit steady, and not kind of ramp up and heat up a little bit too quickly again. But I think that they're done raising rates, to be honest. I think we'll see another pause. I think things are going to continue to trend with, unemployment maybe ticking up a little bit. Rates hopefully will start to cool down a tiny bit. And I think that, we're going to, at least based on futures percentage wise, as of this was end of yesterday, was that on March, there's a 32.7% chance of a cut now and over a 50% chance of a cut in May. I think Morgan was kind of the first big shot, Morgan Stanley, to kind of throw their hat in the ring of they will be cutting rates by June. But I guess that still could mean there could be a raise in the interim before they get back to cutting. But I'm of the camp that they're going to hold steady here for a little bit and see how things pan out through the at least end of the year and into Q1.
Yeah, it's I think the most important news is one of our amazing producers, AJ, said how amazing I look on camera today with my jacket. So thank you, AJ. Thank you. I had to do it. Like, that's what I'm going to lead with for sure. I'm, words of affirmation. That's my thing, man. Tell me I look good and I will bring the heat out here. So yeah, it's 30-year rate is down a little bit, right? So 30-year mortgage FHA today says 7.62. Mid-October, it was as high as 8.3. 30-year fixed conventional, though, still 8.3 today. down from 8.7. So down a little bit mortgage wise. But I think what we said on the pod a couple weeks ago when I was driving, maybe a little bit last time, is one of the reasons I think the Fed is going to not help with rates and why I think they're going to raise them still is, if anything, the CPI numbers have showed them they don't need real estate for the economy to go good. And when unfortunately, and I love real estate, I'm 99% invested in real estate. That's what I do. That's what my software is. That's what my investments are. So so I'm giving the truth, not what the truth that I like, right? What I want to believe is different than what I believe. And what I believe is they're saying, well, we don't need real estate for the economy to be good. And actually, when we use real estate as the driver of the economy, there's a lot more chance for things to go wrong. When affordability for where people live goes up, they don't like that. That's not good. When people are making millions on trading multifamily by raising rents and things like that, I love that business plan, but people don't like it. And so I think one of the things that the numbers shows us is essentially just that, the idea of, hey, real estate's been getting crushed. Hey, economy's still pretty good. Why would they bail out real estate when the rest of the economy is okay? Because the longer they can have like a steady life and inflation is if real estate actually stays kind of down and slow, and mortgage brokers aren't making $4 million a year, and real estate brokers aren't making $4 million a year with a high school education. Like they know that that's a problem when it comes to inflation and stuff like that. So that's part of that. Maybe I'll pull up part of the article. Everybody knows we're big fans of the All In podcast. And 3 weeks ago, Chamath said, hey, I think we're at the bottom when it comes to stocks and things like that. He said, it's time to jump in. And if you'd have jumped in that day on stocks and Bitcoin, right, you'd be way up. Bitcoin up 5% today. And so why should you guys listen to podcasts? Because we actually give our real expectation. We give our real predictions, and we don't have a dog in the horse. Really, we're not actually selling something. So it's really cool to see when people make calls like that, Chamath. And if you would have followed it, you would have done pretty well over that last little while. And the article that I'll pull up really quick of the other side of the Fed thing. So that Powell said this was after the report came out. So Powell says Fed is not confident it has done enough to bring inflation down. So the Federal Reserve Chairman Jerome Powell said Thursday he and his fellow policymakers are encouraged by the slowing pace of inflation, but are unsure whether they've done enough to keep the momentum going. The Federal Open Market Committee is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We're not confident we've done that yet. So that tells me they're going to do it again until they hit 2. But I also think it backs them where the fact that, the economy is doing pretty darn good, even though real estate's getting freaking crushed. So they're like, who cares about real estate? It's a very different monetary policy. I'm a little bit afraid that our next 10 years is going to look like that because I'm going to have to, make some big pivots and stuff. But anyway, that's my opener.
My question is, in what way do you think real estate's getting crushed right now?
Well, we talked about last week the commercial and office level of the $50 million building that sold for $30 a square foot, right? Yep. When the replacement cost is $500,000 and no one bought it, right? No one wants it. And there was a hotel that this kind of the same thing happened. And there was a bidder there that showed up with proof of funds. He owns a bunch of hotels, and it was cut from 30 million to 14.5. And he's like, no, not a good enough deal. And he showed up to buy that hotel. He knew about it. He knew all the stuff, owns other hotels, and a 50% off wasn't good enough to buy that deal. And so I think that's the part of real estate that gets crushed. And then, housing prices are fine. They're stable. They're going to go down a little. They're going to go up a little. But the more part that gets crushed is the service providers, the mortgage brokers, the agents, the software companies. So many places have helped drive real estate to be big. And just with less volume, you have so that the consumer is fine. And again, I think this is where the Fed says it's okay. Yeah. Consumer's fine right now.
Right.
Houses aren't affordable.
The industry.
Right.
As they are about the economics behind the machine. But I think that with the industry, and they're going, oh, there's attrition in this area, and that area, and this area, and that area, that's consolidating, this is consolidating, and our values and our backstop, which is ultimately the values of the asset, right? The other things are all ancillary cogs in the wheel of the machine of real estate. So to me, it says that attrition in their book is not really an intrinsic stressor that they're worried about in the overall economics of at least the single family machine. And I think obviously commercial is where we're going to see some turbulence and some turmoil, and how big of a shoe falls on that side is still TBD. But I'm very interested because we got an estimated $2.78 trillion worth of commercial real estate loans will mature by 2027 with the T. So that is an insane amount, right? And if there's not demand or liquidity, or, just real, I think, business activity in those particular verticals of commercial real estate, that's where I think the big TBD is on how much of a ripple effect that has in other areas of the economy. Because $2.7 trillion in commercial real estate, having to transact or, retrade or, having to refinance or whatever it may be, that's the big, I think, interesting piece to me that will create some great opportunity, but also could create some additional hardship down the road. I'm not worried about single family at all.
Yeah. I'd really quick on that, and I'd like to see what Ash thinks about all of our stuff. But so they're like, okay, so people can't buy new houses, but they can rent them, and rents are coming down, so they're actually getting more affordable. So who cares? People have places to live. We had like what some people would say is a 2.5 million housing shortage. Well, right now there's 1.6 million units under construction of single family, and there's like 2 million units of multifamily under construction. So in the next 12 months, we'll have 3.5 million new units on the market. So we'll no longer have a supply shortage in the U.S. Of housing. And so I think they see that it is kind of like Mike's idea of who cares? Why would they change something when they're like, now the other industry it affects, I think, a lot is the car industry, the car purchases, because loans are much higher for cars right now. And the people that it hurts the most are actually people with low credit. I read an article this week about these people in like buying cars with like 23% interest rates. And the company said they're absolutely crushing it. And 35% of people get their car repoed that are in the program. But they're like, who cares? They could sell them cars for more than they're worth. They can finance them at 20-something%. They can repo the car and sell it again. It's just like the old seller financing, selling a crappy house to somebody that doesn't have any credit. And it's happening in the car industry. So I think the other industry that these higher rates might take a little while to hurt is the car industry. But who it really affects is the people buying in the used car industry. I got great credit, and I bought my 16-year-old a car, and I have a high interest rate on it. But I was like, it was exactly what I was expecting, right? But it was like, wow, that's my highest rate loan of anything I've ever had. So, yeah. Anyway, so Ash, how's that? What do you think about cars or houses or things like that? And how's it affect your industry?
I want to talk about a few things first. So I love how we talked about the 10-year vision. So I'd love to get your guys' perspective about the world of real estate given what's going on in 10 years. But let me kind of start out with like industrial businesses, because I want to share what's going on my side. I just came back from New York from a trade show, meeting hotel owners and designers and real estate guys and all in the hotel space, travel, entertainment, etc. So, I mean, the market is so hot right now; it's unbelievable, and we're doing better than we've ever done. People are not shy of spending money. Definitely, prices are higher than they've ever been. So things are moving, and in my Vistage group also, things are pretty much every single business in my Vistage group, all industrial companies in different segments, non-real estate, are doing better year over year. Most of them are doing better than they were pre-COVID. So things are just solid. I was just looking up this. This is Amazon's Q3 fiscal 2023. And you can see pretty much every single revenue line item is up at Amazon, right? So I don't know if you can see that properly. Maybe I'll zoom in a little bit, but their online store up 7%, physical stores up 6%, third party, which means everyone who's selling product online, making through commissions or fulfillment, shipping products, up 20%. The subscriptions for Amazon Prime up 14%. So people still have money. People are still spending their money. Yes, maybe they're not buying their houses, but they're still day to day spending their money. They're still traveling. They're still ticket prices are higher than they've ever been. They're staying there. It's like $1,500 to fly across country.
Yeah.
Right.
Hey, maybe
credit, and we mentioned, yes, credit cards and all that kind of stuff, but the businesses themselves are doing better, and businesses are doing better. That money trickles down. Jobs stay high. I was just sharing before we started recording that we've been interviewing a ton of people, and you're not interviewing, unemployed people that like we had to do during COVID, or the quality of talent out there that's looking to make moves at good companies is incredible. Um, people are out looking for good opportunities for the next wave. Maybe they had to leave a company that kind of struggled through COVID or didn't make it, and so that's really interesting to me. I've also been following, after we talked about it here, Mooch, about the auctions. I've just been watching some 10x auctions in the last few days, and like there are deals selling, with current bids expiring in like an hour, 2 hours, 3 hours. $30 a foot, $40 a foot, $50 a foot, huge high-rise buildings all across the country, pennies on the dollar, right?
yeah.
And it's just scary. And I think that a lot of people are going, and this is what I want to pivot to you guys and ask you is, a lot of people are betting, and I wonder if you're betting on the same thing, is, okay, I'm betting on getting into a deal that maybe pencils now at 8%, assuming that in 3 years I can refinance. But what happens if that's not right? And what happens if we said this a few weeks ago, is like, what happens if this just continues and we keep printing money? Government, no, nothing really changes. We keep printing money. Inflation goes even higher. Interest rates go even higher. What if they go another 3 or 4% higher than they are right now? We can't be that naive to think that we're at the top. I mean, in the 80s, interest rates hit 15%. So who's to say that it can't go higher? Who's to say?
Yeah.
So in 7-8 years, I think in the Vistage community, there's a big economics team called the Bolio Brothers. And they are projecting that in 2029, 2030, there's going to be this like big recession. And they got all their statistics and data and all the things, their indicators that are communicating to them that, right, that in 2029, 2030, there's going to be a big recession or depression. And I just want to really understand what that means to the real estate world. So if something, we bring in this bias in our opinion that interest rates can't go higher. And if they do, maybe half a point. But who's to say it can't go up 3% more, 4% more, and just wipe people out? And you're right. If the Fed doesn't care about commercial real estate, it will wipe people out. We'll have a full reset of the entire system.
What is the Fight Club? Where they wanted a full reset of the entire system. I mean, check that out. Like, Ash isn't wrong, right? So we look at the last 50 years of interest rates. Now that's also ridiculous. I hate it when people say that, like, look forever, because the last 20 years have been different. Yes, but prior to that, like between like 1990 and 2000, it was a certain way, and then all of a sudden it changed. September 11th happened and it changed, and then it started going, or like from 1960 to 1980, it was one way, and then something changed. So stuff changes. So even though it's been away for the past 20 years and people say it can never happen. And what I'm showing on the screen, guys, is just historical mortgage rates, where right now they're higher than they've been since October 6th, 2000, which was right before September 11th. So now we're back to where we were before the Fed used the interest rates and housing as a weapon for the economy. And if they decided to just hang out here, and it was like between 1990 and there, we should see rates for Fed fund rates between 9.75% and like 8.23 where we are right now. So, and who knows if that's really what's going to happen. So how do you make money today, Ashish and Maddie? You plan as if rates are not going down. You
Yes.
plan as if rates are going up. That's how we're doing all of our refinances right now. That's how we're doing all of our things. Like, because anybody last year said like, hey, I'll wait 12 months. It's going to get better. I remember having a chance to even like when some banks didn't refinance me early 2022. And like a week later, they're like, sorry, you probably don't even want these. I can get you DSCR for like 5 3/4. And we laughed. We're like, oh shit, I'm not doing 5 3/4. I'll wait for it to come back down. And now it's like, oh my gosh, 5 3/4. What an amazing thing that would be. So we need to plan as if they aren't. No, you're not going to be. Don't buy something thinking you're going to refi in 2 years, 3 years, 5 years, 10 years, which means it's going to be harder to buy something. But that's why some commercial stuff is getting sold for 75 cents off. Mm-hmm. So you don't buy something that way. But hey, that could be a bonus. It's like accelerated depreciation being a bonus on a good investment. Or if rates do come down or there is a change, then there's upside. But don't make bets planning on it, because the people that made bets planning on it are the ones that are losing everything right now. We did an interesting thing yesterday. And so real estate agents are like, all right, we're going to go kill ourselves. What do we do? Here's something you can do. We did a search on the MLS yesterday, and we plugged in financing type and we plugged in assumable. And there wasn't a ton of them, but there was 20 houses on the market in this little town. And one of them said, with 10% down, you can take over our 3% loan. And so you could buy a house. It was a $220,000 house, so that you could buy it. You could put $22,000 down and your mortgage is 3%. So the payment on that was going to be $700 a month, and it would rent for $1,500. So like there's a deal to be bought right now on MLS or for an end user buyer. So agents should be like finding that, go marketing that to their buyer, because that same house, even if they got $20,000 off by buying the neighbor's house for $200, their monthly payment's going to be $1,400, $1,500, $1,600 right now. So there is opportunity out there. But yes, I think I do not think, Ashish, that you make bets assuming rates are going to come down and you can refi right now.
Agreed. I just don't think that
it's like a foolish. It's foolish, right? I mean, people are underwriting deals assuming that they can get that done. Maddie,
well,
we're
Aaron
talking
said
about
it
that.
perfectly, right? Because just rewind 18, 24 months, and everybody that was saying they've got the best, syndication opportunity, that ultimately the value add was based on, pumping the IRR, and the cash on cash return was based on refinancing these deals, getting investors their money back. They had to be in somewhat of a, low leverage position. And if they weren't, now with not only interest rates being where they're at and most of those assets trading on cap rates, which inflated over that time, value gets sucked out of those assets. Now you've got a double, whammy on your property. So you can't do that in this type of climate, right? You have to mitigate that risk going in and saying, does this deal work with these conservative assumptions baked into my pro forma? And if it does, I can do the deal. And if I have the opportunity to refinance at a lower rate later on, that's just icing on the cake, and I'm going to look like a hero to my investors. But I gotta mitigate every possible risk, variable in this equation, because if you do right in this next season, I think there is going to be massive upside and opportunity for people that were conservative, smart, but still stayed in the game and didn't completely sit on the sidelines. But I think we'll still see multifamily be a relatively stable and competitive asset class. It's why obviously the market and investors agree with that. It's the lowest trading cap rate asset class in today's commercial landscape. And then I also think that there's going to be some great opportunities for those traditional 7 and 8 cap type of properties that people are still trying to sell them as 7 and 8 cap type of properties, when really you should be getting them at like a 10, 11, a 12 cap property. And if the market stabilizes, right, you can squeeze those back down a little bit and still generate some healthy cash flow along the way. And I love what Aaron just talked about on the single family side. You can do the same thing on the commercial side.
Yes.
We've got tons of searches set up on assumables, keyword searches, on seller financing or carryback keyword searches, JV searches, right? Sellers are getting more and more open and creative to ideas around seller financing, partnership. Hey, just give me a little bit of money and some skin in the game to help me get some breathing room. I'll stay in this with you. I'll get creative in this deal with you. And those are key opportunities that people can take advantage of right now. But again, it's all about underwriting and building a moat around some of these opportunities to where you can use them as stepping stones in a worst case scenario to get across the choppy waters, but could also be massive launching pads if things pan out and go in a good way. So I think people that are still in the game and leaning in right now are going to get rewarded very handsomely in this next season. And I just find it as one of those times where there's going to be a lot of chaos and a lot of noise around risk. But I always think of Morgan Housel and the speech that he gave, Aaron, when we were, I think where we were at Steamboat or we were somewhere at a GoBundance event. And he said, volatility is the price you pay to getting wealthy.
Hell yeah.
And so when you think about people that if you want to make money, and this is in chaotic and challenging times, the most lucratively based, opportunistic based times to make money, you're going to have to get comfortable with some model. So figuring out what your model is, what your strategy is, not trying to make money in a ton of different ways, but maybe one or two key strategies that you feel comfortable. You can build real skills in it. You can build real relationships, team systems around some of those things. There's opportunity in this market. You just got to be that much more strategic and aggressive of how you go about finding those deals.
Well, we got to get Morgan on here. We got to message.
We got
to get Morgan and have him come on right now because I've had him on my podcast and you had him on yours. He is he's a brilliant guy and I'd love to hear his take on this stuff. So note to self, one of us needs to reach out to that dude.
Yeah, and I'm gonna do, and maybe we can talk about it on another podcast episode, or I'll create some content around it. But I think one of my big bet models right now going into this season, and I think it's actually a little bit opposite of what you saw there on that. I think some of the big companies like the Amazons, right? They're seeing, percentage increases, sales are up, business is good. But I really think if you talk to, and I know I talk to a lot of business owners in my community and just around the country, and a lot of people are getting pinched right now. The cost of doing business right now, the cost of goods, the cost of services, the cost of rent, inflation, businesses are feeling that. And not all of that can get passed on to the customer. And so profits are actually shrinking for a lot of businesses, and stress and time and energy requirements to go in to make that amount of pinch profit now is really wearing down a lot of businesses. So I think Main Street could be a great place where, one, there's some opportunity to come in and buy some of those businesses, pull a Cody Sanchez and go and buy some boring businesses. But I also think, that's going to hit commercial real estate too. And one of my models is looking for certain key strong franchises that have national footprints and are actively looking to grow and understanding what their criteria are. I'm doing this essentially on this deal out in Nashville. We got a good buddy, Aaron and I do, David Laver, who's been doing this with Crunch Gyms. If you can find those tenants in tow, there's a lot. I'm seeing more and more of them, dark, ghost, vacant commercial buildings that could be in great locations, but the owners don't understand how to go out and find that next tenant and secure that income stream in. So they're going to sell those assets at a pretty heavy discount just to get them off their books and not have to worry about re-tenanting those spaces, redeveloping those spaces. But if you've got a couple key quality tenants that what their criteria is, and you can find those assets in the locations they want that fit their operating business model, you can secure those income streams before you actually even take the risk and close on those assets, force the value into it. And that's a really good model that I think can make some pretty significant returns for people in this kind of market if you've got those types of relationships.
Yeah, I just want to double click on that because I agree with almost everything you said there. I think that on the real estate side, there are deals that sellers know that they have to lose money in order to offload them. They're not willing to maybe put that in the price, but once you start getting on the phone, they
Yes.
know they're going to have to cut into the bone to get this thing offloaded. I was just working on a project where one of them, it was clear that he had to sell it below his note. And once you're talking to the broker, but he's like, well, there's actually another deal that he's also selling. So maybe there's a creative way to collateralize the other one in order to make this one happen. And so there are definitely conversations going on because people are going to have to cut in the bone. I think that's where the opportunity is. But I just be careful because I also think that just because you have the deal cash flowing now, right, Maddie, where it's tenanted up, there are people in the office building or retail center. Let's say an office for a second. There's still businesses that are going to still downsize. So just because it's leased up today doesn't mean in 48 months or 24 months it's going to still be leased up.
Yep.
So there's still a lot of pain, I think, but that's where the opportunity is for the listeners, right? Is stay in the market. I think the lesson for me today is just be overly conservative with your assumptions.
Yeah.
Don't be a fool's errand. Try to convince yourself of things you cannot control and don't know. Don't hurt your investors. I think what's key in this market, at least for me, it would be, is don't screw up your own personal reputation by overzealous, non-conservative assumptions. Right? In the first few
Well,
deals in the next few years, if you're screwing up those assumptions and you're wrong, the next decade of opportunities are gone for you. So get right those assumptions. Make sure you're overly conservative, and then on the business side, same thing. Right? Just be thoughtful of those assumptions.
well, Aaron and I know a handful of people that in the last few years were not conservative with their assumptions. We're right in the this party is never going to end train, and their reputations and their deals and their investors have all gotten hurt in this process.
They're done.
Yeah.
They're done. I
So
mean, the people that messed up deals in the last 2 years, done. You won't be
Mooch, I
able to
mean,
raise money again.
do we think we're at the bottom in any of these sectors?
You talking about in commercial real estate specifically, or
Commercial,
in business?
residential, anything? Can you trend set any
Well,
bottom you think?
I mean, on the single family side, right? I mean, Redfin, Zillow, NAR, a lot of them have already started to kind of bake in the fact that they're probably going to cut at some point next year. With supply where it's at and demand probably going to tick up once those things start to happen, home values are going to continue to steadily appreciate. I don't think it's going to be drastic. I think NAR said 2.1 to 3.1% in appreciation. I think it might be in the 5-6% range, maybe even higher.
Mm.
But that being said, I think commercial is where the real opportunity is at. I think single or multifamily has definitely started to expand out a little bit more. Rents are starting to soften a tiny bit, but I still think that's the most stable asset class. So I'm not sure if, bottomed out. I think maybe, depending on, where we start
In
the year next
multifamily.
year. But I think office, no, there's still so much carnage to come in that particular space, that I really think that's got a ways to go to find the bottom. And then on, all the other different asset classes, it's kind of, I'm curious on your take on this, Aaron, but it's kind of hard to say what's hit the bottom on retail, because I think there's a couple different variables of whether it's big box, anchored retail, family retail, strip, right? There's a couple different categories and classifications there, that I think those, some are more stable than others. And then you've got, mobile home parks, RV parks, hotels, a lot of those asset classes where I think hotels have actually weathered the storm pretty well. And I
Yeah.
think based on how the overall leisure economy does over the course of the next year or so, that's going to trickle into hotels. So I think hotels might, still have a ways to go to find maybe some settling in values there.
Yeah. I think so I'm going to Vegas tomorrow for F1. When this thing airs, I'll be there watching, sitting next to the Sphere as cars go racing by. A year ago, when tickets came out, the Wynn had $1 million package that you could buy. They had a $500,000 package, a $250,000 package, and their base price for a room for 3 nights and tickets to F1, their cheapest one was like $30,000. And I'm a huge Vegas fan, and I'm a huge F1 fan. I'm a huge fan of the Wynn, and I was heartbroken because I'm like, okay, I want to go waste money and go do this, but I'm not going to do a $50,000 package at the Wynn. So let me stay at a casino next door that's not as good that I'll feel like a I won't say the wrong words here. I'll go to one next door that I don't like as much, that I can get a package that's like, let's say 15 or 20K instead. And I remember being like in a panic, like I need to book this now because this thing is going to sell out. And this week, hotel prices are dropping like crazy.
I just saw
ticket prices are dropping like crazy, and you can buy the same package I bought for $7,000.
I'm coming. I'll see you tomorrow.
Yes. So the book a flight, get there tomorrow. This might be the only time Vegas does it. And so, yes, for anybody else that's hearing this, it's too late. But for Maddie and Ashish, it's not too late to go meet me in Vegas. It's going to be a once in a lifetime thing, probably. My point of that long ass story is that is the people going and spending money in Vegas for F1 are people that have extra spending money, that like leisure, that like travel. And so there's a type of hotel that I think will do fine or okay, but there's another type that isn't necessarily, because Austin F1 was packed, but it wasn't quite as expensive. And traditionally, the people that go to F1 are the ultra wealthy because it's a ridiculously expensive event to see the gazillion-dollar cars. So anyway, my point with that is the uber wealthy are being tighter with their money, much tighter than Vegas predicted. And Vegas is really, really good at predicting. So
yeah, they are.
So they got that one. So they got it wrong. They got that one wrong, and they don't get stuff wrong very often. So that tells me there's less money out there. It tells me that hotels are going to hurt a little bit more because we're going to see it first on that level. When I saw the guy not buy the hotel too last week at auction, when he was ready, he showed up wanting to buy the hotel, and it was heavily discounted.
That's
and
crazy.
Then he didn't. That was like, whoa. That was like he actually had done his homework. He was ready, but he wanted to buy that thing for 40% off. Your bigger question of are we at the bottom? I think that this is a really interesting take that you guys might like. Median prices, the average houses, and the reason we're seeing like prices are still going up and prices are fine. The average deal, we're not at the bottom yet because there's still there's a lot of stuff listed that isn't closing, that isn't selling. And when it does eventually sell, it's going to sell for a lot less. But I think you do have the opportunity today, right now, to buy a deal that will be the best possible deal you could get for the next 10 or 15 or 20 years. I do think that you could buy a house today at the bottom, even though we're not at the bottom. So what does that mean? That means if a property if the median price for that specific house right now, if all of them are selling for $100,000 right now, right, the median prices are probably going to get down to 90, 80, 70 in a worst case scenario, right? Worst case scenario. So I say probably, but in a worst case. So like take out the probably. So if the median price is 100, if we're saying we're not at bottom yet, maybe potentially it can get down to 70,000, which is another 30% discount, which would be significant, right? So that's about as far as we could go. If I said, yes, like how much further could the bottom be for single family? Another 30%. I don't think we're 30% away, but I'm saying that would be like a max. I would be absolutely shocked. But I think you could buy a property today for 30% off. 30% off of today's $100,000 list price. So I think you could buy a house for $70,000 when it should be worth 100. And even if the other prices continue to go down, they're only going to get down to like 80 or 90. So we're not at the bottom for an average property. We're not at the bottom if you're like, okay, I'm going to go buy any sort of thing on MLS. But there are deals to be made right now, and they're once in a lifetime deals. It's the same thing as that one house where it's like, hey, take over my 3% payment.
Yeah.
Right? Take over my 3% payment with 10% down. Because I think you could probably go give the guy $3,000 and take over his payment at 3% down instead of giving him 25, right? And then that is going to be the deal of a century, right? Because you're getting to take it over. So And in the other industries, when I'm trying to compare industry to industry, if you look up articles, you're going to see as many that tell you storage is unstoppable in recessions as compared to say like it's hurting right now. And so if you go out and read the news, every asset class is in such a mixed bag of saying, hey, it couldn't get any worse. Hey, it's not it's not going to get any worse. Hey, we're on our way up, or hey, we're unstoppable with that. And I think back to like maybe a month ago, we can all agree, like, I don't think multifamily is at its bottom, period. I think there's going to be way too much foreclosure stuff that happens. Makes me sad. I have some big multifamily that I had a lot of my net worth tied into, so it makes me sad. But I don't think multifamily is done correcting because of the cap rate thing and because of how much stuff is refinancing. And the commercial office we know is a time bomb. And when you have those two big time bombs and people lose all of their money that they raise, it's going to affect other asset classes. So that's why I think it'll affect other stuff. It won't affect single family as much because single family buyers will just become renters. And because we have 2.5 million or 3.5 million units under construction, there is not going to be a supply shortage anytime soon. And when demand, like they would actually have to, rates would actually have to lower like 4% now to get demand back up to be enough when they actually build that infrastructure. I think the last point of what Maddie made that I think is interesting, don't make them like, it's better to not do deals than do a bad deal. 100% it's better to not do deals than do a bad deal, because if you do a bad deal right now or you guess wrong, like I remember being so upset in 2019 and 2020 when amateurs were making a post on social media and raising $5 or $10 million like it was nothing. And I was like, when I raised my first $5 million, like it was hard work, because essentially it's illegal to post it. There's like so many laws that are broken, right? And I remember just being angry about it and going, how is this guy doing that? And how is this guy doing that? Well, and the proof came out in the pudding. Like the proof finally came out over the last year, where now these people are getting crushed. They're losing 100% of investor equity, and no one will ever lend them money again. No one will ever invest in them again. No one should.
But Mooch, there's still the amount of liquidity out there. It's still an absorbent amount of liquidity.
Right, but
It's just all the bad actors got wiped out.
Yes.
Well, the amateurs
and
some amateurs did fine. They did refinance in time. Like I shared the deal with you guys where I barely pulled off a refinance in time and it made me look brilliant. So I also know that the guys that screwed it up, like, it happens too. Like I'm not judging for when I'm saying it, because I've had so many close calls myself.
I just think you just got to be careful on the assumptions. That's it, right? I mean, this could equally turn higher. And if it gets worse, are you prepared? And then also, do you have the ability to generate cash? If you're just investing real estate as a syndicate and everything turns on you where you need an additional 20, 30K of a month in cash, can you solve that problem? Right? So having this equation of having businesses that generate cash and then also investing in real estate is a critical component in this. One of the things I feel like, and maybe we'll get a little more philosophical. Do you want to say something?
Well, just I have another business idea I want to throw to you guys, but let's get philosophical first.
Well, I just think, let me just say this and then I'll turn it to you because I don't want to go off tangent. Is one of the things I learned in this last cycle through COVID was that what makes most people successful is not that they're smarter than everybody else. It's that they can just survive for a longer period of time. Like for me, last year it was probably the bottom of the bottom and then the top of the top in 1 year, 6 months apart. And you think you know what you're doing. You think when things are great, you're like, oh, I'm so genius. And then when things are falling apart, you're like, oh, fuck, it's all the environment, the circumstances, the interest rates, money supply, it's the government. You're blaming everyone outside of you, all these circumstances, right? So it's such an interesting contrast. When you're doing great, you take all the credit. When things are going bad, you blame everybody else. But in reality, you're not in control of most things anyways. And so what I love about the conversations we're having here is it's mostly about, you can't control what's going to happen in the market, but you need to know when to jump on the waves, when to jump off the wave, when to get on the surfboard, when to jump off the surfboard. And I'm not advising timing anything. I'm just saying being smart about that knowing that it is coming in waves, and then how you approach it and how you kind of design your life with money in, money out, investing, all those kinds of things to be able to weather the storm as long as you possibly can. I think some of the people that are closest to me made all of their wealth. They look rich and they've looked rich for 30, 40 years, but they made all of their wealth in the last 6. Right? And what made them successful wasn't the last 6. It was that they just survived for 35 years to experience the last 6. So that's all I wanted to share. Because we really are not smart enough to know where the hell this is going. And you can't sit here and predict what's going to happen in 10 years. But I just think that the reason why I was asking those questions, and even for the audience, is like some of us are young here. We got a long life to live. We got long business careers to happen. So for making bets today, you don't want to make bets assuming that the world's going to fall apart and things are going to go absolutely haywire in 10 years. You're just getting yourself into trouble. But that's the only reason why I was asking. But it really is about building the infrastructure so that you can survive these storms. And I think what I'm really observing in myself as I'm navigating this journey is, man, how foolish are my assumptions? How foolish am I to think that interest rates can't go higher? How foolish am I when a broker calls me and says, these are the facts? It's like, oh my God, so many assumptions, because we have this natural wanting, like we have this desire to make it work as an entrepreneur, right? And that instinct, that positive, I think it's a gift in some ways of like trying to find a way to make it work, right? Being optimistic can also kick your ass. So just interesting anyways, that's what I wanted to share.
It's a great point, though. I think what it reaffirms for me, what COVID did at least, and kind of, with how many crazy things go on in the world, what feels like every year now, is I'm just at a place, and I think it's taken multiple failures, multiple, face plants, getting, pushed up against the wall, and just experience in life, right? Because I heard somebody say this the other day, and I thought it was really good. It was that you have 3 seasons in life. You have a season where you're building and becoming a warrior. You're growing your business, you're growing your family, you're fighting, you're clawing, you're scratching, you're proving yourself, you're growing into this warrior that can kind of trust in itself to withstand the roller coaster of life and business, right? And the second season is, you persist and you withstand and you fight enough battles. Eventually you're going to win some war, and you're going to become the king of your domain, and you'll have security, you'll have freedom, you kind of make up your own rules, right? And you are in charge. You're in the driver's seat of your own destiny, and you're kind of outside of the matrix. And then the last one was more around this sage, and getting to a place where you're giving back, you're being a mentor, you're sharing your wisdom and experiences, you're more focused on impact. And as I was thinking about that, I also was reading the Stephen Schwartzman book, the founder of BlackRock. And one line that he said in there that I think applies to all of those seasons, and I consistently keep replaying this in my head to maybe reshare this with many of you who are looking at this season, this chaos, as opportunity through, optimism. And it said, doing a really big thing and a really small thing require the same amount of effort, if not less. So you might as well go after something so big, so extravagant that inspires you and challenges you in ways that something small wouldn't. That this is the mentality that got him to the level that he got to, was just thinking so irrationally big that by doing so in every area of his life, and that's something that I think we can all apply at every season, every stage in life, is going, whatever I'm thinking, how could I challenge myself to think 10 times or 100 times bigger? And the paths of getting to that outcome becomes so much more narrow and narrow and narrow. And for people like us, we're good executors. right? It's just when we don't have clarity in what path we should be walking down and how we need to walk down that path that we get spread thin, we mistake movement for achievement, we get really busy. And so for me, where I'm trying to challenge myself philosophically right now is going, where can I continue to think even bigger? And I'll give you an example. One of my goals for achieving $500,000 a year in passive income was over the next 10 years, and I started this when I was 30, is I just need to buy one asset a year that nets me $50,000 a year. And then I got clear on what that criteria was and what asset classes could allow me to do that. Well, in this market, what I'm buying right now in Kansas near another medical plaza that I have, I'm getting almost an 11 cap on it. It's 100% occupied. I'm using some of my 1031 funds from another sale, but the seller is carrying back paper for 3.5 years at very favorable interest and terms. And that property is going to net me $175,000 a year. And so and for me, it was like, why keep trying to do $50,000 a year deals when now there's a potential season? I'm in a potential space in my life, in my business, and my skills and my relationships that I might be able to get a $300,000 a year building or $150,000 a year building. So I also think it's a good reminder for anybody right now that's looking at what this season ahead presents is going, whatever your initial goal or desired outcome was in this season, what could it look like if you tripled it or 10x'd it? And that was actually a reality. And it was just retooling the target a little bit and how you aim at that target that actually allows you to cover some ground and achieve something beyond what most people are looking to achieve in this season. And that's where I think those are the people in 5 years you're going, man, that guy, he was smart. He did something different than everybody else, right? And it was probably it just started with a little bit of a shift, a degree different of thinking.
Yeah.
Mooch, bring us home, and then
I'll try to bring us home. We won't do my business idea today. I'll remember it for next time, because I think we've done a good chat here. I mean, I really like that Steven Schwartzman quote where it says, the effort for a big thing is the same amount of effort for a small thing. The devil's advocate to that is the risk versus reward scenario. If you've got a chance to make a couple million, you've got a chance to lose a couple million. And if you go small, you got a chance of making 20 grand or losing 20 grand. So you are betting on yourself in every version. There will be a time in the next few years to, I think, go really, really big. I don't know if it's right now, unless you are getting one of those deals of a century. If you're getting something for 70% off even today's value, which means 65, 75% off of the value from 2 years ago, well, then maybe you're in the right ballpark for stuff. 7 years ago, I was worth $0, right? When you're talking about all your friends that made all their wealth, it's sheesh. Like, I'm one of them, because 7 years ago I had $0. Really, by the time 2019 hit, I had a whole bunch of houses that were cash flowing, but there wasn't any equity in them, and they weren't cash flowing all that much. So I would say 90% of my wealth was in the last 4. Right now, I did a lot of work from 2015 to 2019 to make it happen. But had COVID not happened in 2020, like, I'd still just be plugging along, getting these houses, and by now I'd have average cash flow and rents in them, but I wouldn't have nearly the worth and the other stuff. So it is short periods of time that these bets happen. I'd also encourage people to try to find the bets that are, and maybe buying 100 houses was doing something big, right? Instead of doing something small, because there was some scale. But yes, if I had gone after multifamily back then the same way instead and had 10,000 units when that hit, maybe it's a little bit different. But I think, if you said, like, the question, to finalize the question of if we're at the bottom or not, or where, if you said, how much would you bet that houses will be worth more 6 years from now than less? I would bet that houses will be worth more 6 years from now. If you told me to do the same bet with multifamily, I'd be maybe 50-50. I would want like some 3-to-1 odds if I was going to bet on that. And if you said, is office going to be worth more in 5 years than it is today? I would say no. Right? Like it's
Really?
really like so if you're going to buy office, you need to be getting giant discounts. So that way, like, you still beat that part out. So those are my predictions. I've been wrong a couple times too. Blackstone sent me their playbook. They said, "Come work for me. Let's go buy a bunch of rentals," and I wasn't able to actually see what that was going to mean. So I got that one wrong. I've gotten a few wrong, but those are my predictions. So I think,
Well, fun.
if we
Where do you
if
think
we
where do
go
you think
ahead.
there's opportunity with Office? Just real quick to wrap that up. I was thinking of all the different plays with Office, and I've talked with a handful of different people that are looking at like what can we do with Office developers, right? People looking at that being an opportunistic play going forward. Well, have you heard anything in
Yeah, we talked about it.
conversation?
We talked about it a little bit last time. Like, they're trying to do this tax incentive and stuff like that to convert office to multifamily, but it is a different beast. Like single story office, maybe, but like if you got a 50-story office building, converting that to multifamily is hard, is extremely expensive. And so,
Yeah.
I think the opportunity is just location and discount wise. If you're buying an office, again, I can't believe no one bought that $14 million one, because in that case, you could have it be 20% occupied and 8% loan and cash flow. So I think it's probably changing the analysis and the way that people look at these. So like if you're doing the analysis and you're like, well, what if I have 50% occupancy? The building I'm in today does not have 50% occupancy. The building I'm in today is like 20% occupied, and it's been 20% occupied for the last 9 months, and it's a nice building. It
Wow.
was a Wells Fargo building. Wells Fargo used to be the whole bottom floor and second floor. There's no longer a bank downstairs. Like, think about this, like this building is 20% occupied, and they show our units all the time, and nobody's renting over here. So like, what's the best case for this thing in the next 5 years? 50% maybe, because they built a bunch of nice offices downtown that I would much rather have that view. And if those stay vacant, they're going to let me rent those for the same price I have this one in. So I think the opportunity with office is super, super discounted stuff. And then probably turning those bottom floor office stuff into more retail. Like there could be a restaurant downstairs. There could be some other stuff, but you're still only 25%. There's probably some bigger opportunities in there. I think the opportunities to be made are super significant discounts in whatever asset class you're buying in. And if you're not getting a super significant discount, then you are falling in love with the deal and you shouldn't be buying. And that's the advice I'm following. The best part, wealth is made in these times. Again, like Shamath a couple weeks ago said, "Hey, stock market's at the bottom." And if you'd have invested in Bitcoin stock market when he said that, you'd have made a lot of money. So there's opportunity to be made right now. Next week, I'll talk about my new business plan idea. Maybe somebody else is going to jump on it too, because I get some of those now and then.
Let me
But
ask
Maddie
you.
and Ashish, it's been fun.
Yeah, I know. Let me ask you guys a quick final question, and we'll go around, and then we can wrap up. What are you specifically learning right now? What are the skill sets you're doubling down on in this season to help you, or what skill sets would you advise the listener to double down on, given the conversation we're having? So let me go first, actually, because number one, I think for me, I'm spending a lot of time on marketing, a ton of time on sales funneling, understanding how to write scripts, how to find off market deals. Maddie, you were talking about that. Um, how to use certain softwares to prospect and to increase the probability of close and all this kind of stuff. For me, also, this was part of that skill set, is getting on the phone, understanding what's going on in the world, right? Having these conversations in real time, making predictions. That was a skill set I wanted to have an opinion, be able to defend that opinion. That skill set can be used in many, many places. So what skill sets are you guys learning right now and doubling down on?
We're really heavily focused right now on AI.
Yeah.
I have really, and I'll just use a simple and easy example is, my person that was doing show notes, the person that I had doing sound engineering and a lot of editing stuff. I just didn't need him anymore because we've got, our full stack marketing team and kind of tech team that is really leveraging AI in a lot of different other areas of the business, going, hey, I can actually eliminate a ton of human error and overhead with these basic tools, and going, man, if that's just a quick, simple, easy one, right? There's so many other areas of our business or of industries that are clunky, that have human error, that are problematic, and that cost a lot more money, honestly. And I'm not a big proponent of getting rid of people's jobs, right? I want to continue to advocate, but it also is part of how we innovate and create new industries and new opportunities and create better value in certain industries and markets. And we're really digging in on ChatGPT and a lot of the different AI tools and platforms and kind of tech stacks that you can leverage and create links and chains and, kind of synergy with. So that's a big one. And the easy one, my easiest answer, and where I still think has the highest ROI for the least amount of effort with most people, is just networking and relationship building. Right now, the people who are being active in their relationships and leaning in and learning and going to events and are networking, I'm really doubling down on that, because those are the people that I want to be connected with, that are in the game, in the hunt, in the battle. What are they seeing on the front lines? Who are they talking to? And ultimately, by having those key relationships and you being top of mind and adding value, I really think that's where you're going to find the most opportunities in these seasons. You need help with something, somebody who can help you with. You're looking for something, somebody's going to be looking for it and how they can bring it right to your feet without you having to go and do all the heavy lifting for it. So relationships is a big area that I'm really doubling down on right now, and that I think is going to pay dividend in the next, 3 to 5 years. I'm a farmer, right? So I'm planting seeds. I know that the day I plant that seed and take that action, it's not going to bear fruit for me. I need to water those seeds. I need to go back and nurture and tend to my crop. And I know that at some point in time, it's going to yield something beneficial. And I'm just, it's a marathon that I'm more than happy to run and be patient with. But right now, if you're not planting seeds, I would encourage people to get back to that basic 101 discipline.
Yep.
We used ChatGPT a bunch yesterday. We're using that a bunch right now. Like the great thing out there, if you do marketing, if you do advertising, if you do anything like that, it's totally changed the amount of productivity we were able to get in a short period of time. So that stuff's amazing.
Yeah.
I think I'm going all in on online branding. We have some friends with these giant online followings. We've got Brandon, we've got Cody, we've got these people that have such a big following that if they lost everything tomorrow and they found a new product they liked and they just went online and said, hey guys, here's a new product I like. You guys should go buy it. I get a 10% cut. When you do, they can make $1 million in a day. Like, it's just their online brands have built up. It's just I had a reel last week that got played for like 500 or 600 hours and still going. And I think about like the amount of effort it would have taken for me to, it would have taken 500 or 600 hours, and the amount of it to talk to people, which how many weeks is that, right? So you're like, so 10 weeks, if I did nothing else, I could have had that many conversations. And so the reach that we have with social. So I'm going all in on that, building an online brand. I'm going to get to 1 million followers. I'm going to get to $5 million. I'm going to get to 5 million followers. I'm going to get to a place where I have reach and influence based on the stories that I want to tell, because that is the best way that you can defend yourself. If you ever go to zero and you have 1 million followers that like what you do and you're providing value for them and they're aligned with you, and you can find a product you're aligned with and sell it. The other thing I'm going all in on is just this. We're using AI a lot on this technology. We're really excited about our software technology that we're doing. Essentially the software that I built to buy houses that now we sell. And we're using, so texting is like one of the outreach pieces. And one of the cool things we can do with AI is every day we're getting a report of like what got marked as spam. And then like when text got sent out. And so then we're able to see like which text, using AI analysis, we can say which text had the highest quick response rate, which text had the highest spam rate, and why. Was it because we sent it from a phone number with a different area code? Was it because we used a different name? Was it so whatever. So we can start to find out that. And then for the ones that turn into hot leads and deals, we can start to figure out like what was the text chain that kept it going. And when your first text was like, hey, Matt, do you own the house on Main Street? And he says, yes, we can start to figure out which one of the next texts is the most successful. So like when I think a year from now of what we're going to be able to do after we have sent millions of text messages and had hundreds of thousands of conversations, the technology is going to be able to tell us this is exactly what you say here. Instead of it being where like we're using our batch thing, like in a year, we're going to be able to say, hey, go. And our bot will be able to customize every single message to go, oh, because this house is worth under $200,000, they get this sort of a text message. When the ones that are worth over 300, they want this sort of a text message. And that's the stuff that you and I can't see enough. Like I can look at some of the reports and go, oh, it was spam because here's the trend that I see. But AI will see real trends. So I'm super pumped about that, as I feel like I'm coming late into an industry because I've done a lot of other stuff, but like this part of the technology part, but AI is going to help me catch up.
Love it. Love it, love it, love it. Well, there's another amazing episode, guys. Missed Mikey today, but thank you so much for listening. Any other final thoughts as I wrap up, or can I wrap it up?
Wrap it up.
Yep. Well, thanks so much for listening, everybody. Again, we just are so grateful for you guys to listen. If you guys have any questions or comments, please send us a DM. Please go to all of our podcasts. Maddie's podcast is the Millionaire Mindcast. Mooch's podcast is the Real Estate Rockstars, and Mike's podcast is Investing for Freedom. And of course, I'm Ashish. My podcast is The Rich Equation. So please follow all our podcasts. Leave us a 5-star review. Leave us comments. Follow us on Instagram. Leave us a DM and send us messages. What are you thinking about the podcast? Do you have any questions? Do you want us to discuss any topics? Please let us know. But thanks so much for listening. Another great episode of the King's Table. Peace.
Later, guys.